Well, welcome back to another episode of the Wilson Weekly. We've got a real treat for you this morning with Dr. Andrew Wilson going back over the data over the year that was of 2023. Welcome back, Doc. How are you?
Yeah, I'm great, Glen. Good to be here. And what a year it's been. I think we can really call it a strong year for the housing market. Certainly strong when we consider it in the context of all the negativity that began the year this year. Lots of predictions, 10, 20, 30% falls in house prices. Lots of doom and gloom. Hopefully the punters out there have just shrugged that off as the usual nonsense that we hear at the beginning of every year. It is called clickbait. Just don't click on it, if you see that story. And this year, what we're going to see now, the year in review, 2023, will validate once again how strong, robust, resilient our housing markets are. So, strap in. This is all the real data up to now, and we'll see how we've performed.
Let's rip in, Doc. Sounds great.
Brilliant. There we go. My housing market is providing all the data, and I'm the chief economist, and I will provide the commentary. And it is all about the year that was. So let's have a look at 2023, the year it was. There are our capital city housing markets in all their glory. They certainly rebounded this year after a quieter year last year. And as usual, they proved to be robust and resilient. Let's have a quick look at how our economy performed because, really at the end of the day, that's one of the key drivers of our housing market. Interest rates, of course, are important. Affordability is improved with lower interest rates. And, of course, affordability is a problem when you get higher interest rates. And we had higher interest rates to start the year, but then the Reserve Bank certainly surprised many by putting interest rates on hold through the middle of the year, way before any of the other advanced economies moved into that sort of hold pattern. But they did pay for it in a sense, having to raise rates on Melbourne Cup Day, but finished the year in pause mode with that pause over December. So that's the interest rate story. I think maybe times will suit the Reserve Bank, maybe even though they went into pause mode a little earlier. I'm not sure we're going to see so many more interest rates, if any, interest rate increases next year. But things can happen out of left field, which we can't predict. But certainly finishing with our rates still well below where they were at that previous peak back in 2011 is positive news, at least for the outlook. So interest rate story, unemployment just ticked up a little bit over November, but that was courtesy of a huge jump in migration population. Even though we created lots of jobs, we couldn't create enough to cater for the tens, hundreds of thousands of new migrants that we've had come in, but still very, very low numbers. We've got to go back to the early 70s to see these sort of low numbers in the 3%, and that was a completely different economy way back then. So the economy's still in very good shape to end the year, despite all that migration. Inflation is still high. Let's not kid ourselves. Interest rates have increased to try to get that inflation rate down from that 7%. It's heading in the right direction, but it's still a long way short of the target. The target is 2 to 3%. We're currently at 5.3%. So still some hard yards to come. But I think the Reserve Bank is prepared to be a little patient going forward. But as I said, the latest data is a bit more positive for the outlook for inflation. Although let's be clear that there's still some work to be done to get inflation back to the target. But it is heading in the right direction. Wages are now up at a record high, so that's good news for those struggling with higher interest rates. Wages increased by 4% over the September quarter, according to the ABS, which is a record all-time high. I'd expect, given how strong our labour market is, to continue to see strong wages growth. So a positive there for wages over 2023. Spending is still high. We're still out there spending like drunken sailors. It's eased off a little bit. The latest data here is October. But we're well ahead of where we were prior to COVID. We're still spending 40% more than we were in the pre-COVID period. We obviously couldn't sustain the growth rates from last year, and that was because of the stimulus package, but we've still been spending quite strong, and that reflects strongly, and that reflects, of course, how strong our economy is and how low our unemployment is and our wages growth. But this data doesn't include the November data yet, and it'll be interesting to see what November is, because November is typically the strongest month of the year in terms of retail spending because of Black Friday sales, etc. So we might be back way above our recent levels of retail spending after November. But nonetheless, it has been another strong year in arguably for retail spending, despite this data being affected by higher inflation and obviously higher migrant numbers, but still well ahead of the pre-COVID levels, and still, reflecting those stimulus package levels of last year. Price of oil is falling, which is good news for those that buy petrol, which is just about everybody. But I put that up there because it obviously shows the relationship between inflation and oil. So let's hope that oil prices continue to fall. It has been trending down for the last 6 months. That's what's helped our inflation rate improve. And going forward, if we continue to see the price of oil fall, it will have an impact on the inflation rate and therefore on interest rates. Now, when we look at the pre-COVID position, we can see that oil was really around $40 US a barrel. So we've still got some way to go to get back to where we were. It won't have the same effect as it continues to fall, if it does continue to fall, as it has recently on inflation, but it will still have a positive effect nonetheless. Building costs, some better news on house building costs, which were a contributor to high inflation and also to low building numbers, of course, because it's tough to get a profitable job when building costs have gone through the roof, courtesy of that previous policy from the government, policy from the previous government, home builder. We saw annual building costs increasing by as much as 23% at their peak, down to 8% now. Still too high, but the trend is positive. So again, some more trends working in a positive sense to have less of an impact on inflation and therefore perhaps a less of an impact on interest rates going forward. And more importantly, in a sense, also provide a better outlook for builders who are looking to put up profitable jobs, without that what is still too high in terms of price of house price growth. Migration, look at that. Whoa, right through the roof. Migration this year, catching up from COVID. The federal government has stepped in and will be easing temporary visas. That's particularly students, because they're concerned about infrastructure provision, particularly housing, higher rents and higher prices because we can't find enough homes to house all these migrants. Not sure that's going to be effective, but nonetheless, there's a lot of political pressure now on the government to do something about particularly the crisis in the rental market. Home building, no real improvement this year, still falling. The federal government's also introduced a policy where it's going to start putting higher taxes on international developers. And with those taxes, it's going to pay for more rent to build or build to rent properties. Now, I'm not sure that's not just shuffling the deck chairs on the Titanic, but nonetheless, the theory there is that they'll be able to take some pressure off the rental market by funding build-to-rent propositions, which really will, in my opinion, have no significant impact on the hundreds and hundreds of thousands of homes we are short of in this country going forward. And it will be years anyway before we see any of these developments impact or move into our housing markets. Home loans, they increased this year, no surprise, as house prices increased, more confidence with lending, and home lending was up. So that's our economic background, Glen, in terms of the year that was. Just a quick overview. It's interesting how a lot of those positive outcomes in those economic factors relate again to the positivity in our housing markets, right? So there's that clear relationship. The economy, migration, home building, etc. So housing market performance. So let's have a look at the latest My Housing Market data, which covers the full 2023 year. So these are the median house prices over the December quarter versus the December quarter 2022. Sydney's still well ahead there in terms of the median house price, over 1.5 million, followed by Melbourne over 1 million, then Adelaide and Brisbane reasonably close together, and Perth. Look at these numbers. So this is the growth in house prices over the past year. Perth led the charge there, up by 15.6%. So Perth house prices, no crash here, no bust here. This is like a boom, 15.6% up over the year. Brisbane up 12%, Adelaide up 11%, Sydney up 10%, and only Melbourne really the underperformer, up by 3.7%. I think Melbourne's actually a bit of a special going forward. Still some potential in that Melbourne housing market. I think there's still a little bit of confidence there that's been underwhelmed by what happened through the COVID period. Of course, Victoria has the worst performing economy of all the state economies, but I do think that once we get a bit more confidence in that Melbourne market, they'll start to pick up prices growth around about the same levels as the other capital cities. But that's just the year. Let's have a look at the cyclical outcomes. So this is looking at current house prices versus the previous peak. So in the previous all-time peak in the cycles. So Brisbane is now 2.2% higher than its previous record high price. Perth up 1.9%, Adelaide 0.8%. Sydney just about back to where it was in March quarter last year, just down by 0.5%, but Melbourne down by 3.1% compared to its previous highest house price, which was similar to Sydney in the March quarter last year. So still some discount opportunities there available in the Melbourne market. But Brisbane, Perth and Adelaide are all tracking at record level prices at the moment, and Sydney just about back to its previous peak. Unit prices, similar results there in terms of the relationship in median unit prices over the December quarter, with Sydney leading the charge from Melbourne, Adelaide, Brisbane, Adelaide and Perth. Over the year, unit price growth very strong in Adelaide, Perth and Brisbane. Adelaide and Perth have smaller unit markets, so they tend to be a bit more volatile. Sydney and Melbourne, lower price growth compared to houses, although Melbourne's similar. But you've got to remember that last year, Melbourne and Sydney unit prices performed better than houses. So a little bit of a sort of equalisation there this year compared to last year with unit prices in Melbourne and Sydney, but very strong results in the smaller capitals there. You've got to understand that Adelaide and Perth have smaller unit markets, but Brisbane has a large unit market, and that's a very strong result for Brisbane units, up by 11.5% this year. So a very good result there for Brisbane unit owners going forward. When we look at the previous peak for units in the cyclical comparisons, Adelaide up 3.2%, Perth up 2.5%, Brisbane up 0.3% compared to its previous peak. Sydney around about the same as its previous peak last year. Similar result to houses, a similar result there in Melbourne also. Still some value there for Melbourne unit buyers. Now, the rental market, horror story, high rents in Sydney, house prices, similar relationship between house prices and house rents amongst the capital cities. But look at how high those house rents are in Sydney. House rents in Sydney up by 16.2% over the past year. Crazy, crazy stuff here. Perth up 14%, Melbourne up 14%, Adelaide up 12%, and Brisbane up 7.1%, which reflects a bit of a dip over November, but still strong results there. Extraordinarily strong results in rental growth this year in all the capital city markets. Vacancy rates, they're just crazy low. These are just crazy, crazy low vacancy rates, really going nowhere. When we consider that 2% is usually the sort of balanced mark in a rental market between, tenants and landlords, and here we are, we're not even at 1% here in these capital city markets, and basically means there's just a chronic shortage of rental accommodation for houses. Unit rents, similarly, Sydney leading the charge there, $730 over November median rent. Look at the rental growth for units over the past year. Again, this is just, instead of being basically all over 10%, they're all over 20%, except for Adelaide, which is just remarkable growth in unit rents over the past year. And vacancy rates a little higher than houses for units, but only Melbourne is approaching anywhere near a balance for unit vacancy rates at 1.8%. The rest are showing very tight rental markets and really no signs ahead in terms of relief. These are gross investment yields based on the current median house price. Perth, the top yield for houses, 4.2%, followed by Brisbane, 3.6%. Much higher returns here, gross investment returns, annual returns for yields for units. Perth up 7.4%, Brisbane up 7.2%, the rest below that, but even Melbourne up nearly 5% in terms of gross yields for units. When we put it all together, annual returns, these are yields plus capital growth. When we add those together for the year, Perth leads the charge, 17.71% total returns for Perth. Adelaide up 13%. Sydney up nearly 13%. Brisbane up similarly nearly 13%, Melbourne up 7%. So good returns there for houses, for both rental income and capital growth, and similar results there for total investment returns for units over the year. Adelaide 18.1%, Brisbane 17.9%, Perth up 17%, Sydney also up over 10%, and Melbourne up 8%. So some big numbers there for our investors and our homeowners in terms of results over 2023. Auction markets, we can see there that auction clearance rates track house prices typically, so it's always good to watch out for those weekend auction clearance rates. You can see there Sydney prices tracking clearance rates, and similarly you can see Melbourne clearance rates tracking prices over the year. After a very strong middle of the year period, markets eased, still providing pretty positive results there for sellers. And of course, we had a big surge in listings over the end of the year. So actual sales numbers were very high, even though clearance rates were lower. Sales numbers were almost double that were reported through autumn and into winter when there were higher clearance rates. But lower clearance rates and higher listings meant higher sales in Sydney. Melbourne, similar results there to Sydney, but lower, but nonetheless easing over spring, but high sales numbers through high listings volumes. Brisbane tracked down over the final month of the year, but it also had a strong mid-year period. But it has a different auction culture, as we always explain on our podcasts. Adelaide just really worked below its 80% benchmarks through the final 2 months of the year, but still quite reasonable results, but followed a really spectacular year generally for the Adelaide housing market, auction market. And Canberra just started to pick up over the last month of the year. And I think Canberra's a bit of a special going forward next year. Bit of catching up. Canberra was an underperformer, and I think there's a bit of catching up to do with the Canberra market next year. So let's have a look at some predictions for 2024. We'll start off with the long-term trend. These are the long-term trends for annual house price growth. And this is capital city house price growth. Weighted average, it obviously favours Melbourne, Sydney and Brisbane because they have the highest number of listings and sales. But nonetheless, you can see in the modern era, and that goes back to the mid-80s, we've only had 4 years where prices have fallen. And the worst was 5.5% in 2018 when we had the mother of all scare campaigns on the housing market. But this year we're up over 8.6%, and the long-term growth rate is 6.8%. So we're above average this year. Good result, nearly 10% result for the national house price for this year. These are my forecasts for house prices for 2024. I think Perth, Brisbane and Adelaide will continue the charge, up by 6%. Prices growth a little lower going forward next year because there still isn't that strong discount factor. But I think we'll be favoured, our housing markets will be favoured by less upward pressure on interest rates, still strong economy and still high levels of migration and still chronic undersupply of property. And that will put upward pressure on prices. Perth, Brisbane and Adelaide up by 6%. Sydney up 5%. Canberra, I think, similarly, a bit of a special, up 5%. Melbourne, I'm also a little bit more confident about Melbourne picking up next year, 4%. Darwin and Hobart, volatile markets, and maybe Hobart could be a bit of a surprise on the upside, up by 3%. For units, Adelaide, Brisbane and Perth up 6%. Perth continuing its strong run of recent years for unit price growth. Sydney up 5%, Melbourne, Hobart up 3%, Canberra 2% and Darwin 1%. So they're my predictions, Glen, for 2024. Let's see how we go. Mid-range predictions. I don't think we'll be too far off the mark. We haven't been too far off the mark, I think, ever in terms of our predictions. And I noticed already there's some, negative clickbait type doom and gloom predictions. They just can't help themselves, can they? Because they know it's a guaranteed headline, house price crash. Well, no crashes here in sight. From my perspective, going forward, another positive year. Not as strong, but we won't be in catch-up mode as we were this year going forward. So as we always finish off, we say that misinformation and ignorance remain the curse of Australian housing markets. We've proven it again this year. Think of all those silly predictions that were made a year ago regarding the Australian housing market, and you've just seen all the results, and they are spectacular, make no mistake. But, of course, those that rationalise the data and the commentary, particularly that we do, which is all data-based, and it has various different angles. So we cover all the bases to come up with our commentary and our prospects in terms of the market. So if you rationalise that data and act on all that fear that the misinformation and ignorance generates, then you certainly have a much more positive experience as a buyer and seller in the housing market. And certainly for 2024, particularly, again, there is nothing to fear but fear itself. And once again, we've proved that. Australia's capital city housing markets head and shoulders. And, just get out the Google what similar advanced economies have done with their housing markets this year, then compare it to the data on this particular podcast, and you'll see that we are global leaders in terms of our housing market performance, and I think we'll be set to remain that way in 2024. So Happy New Year to everybody. All the very best. What's been following up a positive year for housing markets in 2023. We don't want to be too cocky about it, but we told you so, didn't we? And we're continuing to be positive about the prospects for next year and in what is becoming, let's have our fingers crossed anyway, a much more stable outlook for our housing markets. But you never know what's going to come out of left field, and we can do all we can to look at the key drivers and the data as it comes through. But sometimes things just happen as a bit of a surprise. So let's hope 2024 there are no nasty surprises in store, but it's looking reasonably good at least to start with. So good luck to everybody. Good luck to buyers and sellers. And let's hope we have, I'm sure we will have another positive year in our housing markets next year. So thanks very much for that, Glenn. And you have a happy new year too, mate.
Thank you very much, Doc. I appreciate it. And what a year it's been. And you have a great Christmas and a happy new year as well. And thanks for bringing the data to the Infinity fam for the year. And we'll see you in the new year, that's for sure.
Thanks, mate. And it's been a big year for my housing market and Infinity as well. So let's not forget that.
Thanks, guys.